All right, folks, we're live. I'm here with the man, the myth, the legend, Justin Berk. He is our Associate Director of Acquisitions here at Birgo Capital. And we're super exciting for this. We're going to walk through a real live deal. Just came across our desk. What was it, last week or so?
Yeah, just last week.
And so Justin put the financial model together, and we're gonna dig in here with you all. Before we do that, Justin, can you just tell us a little bit about the deal? One of the things, just for everybody watching online, by the way, we're live streaming on YouTube, LinkedIn, and Facebook. So for folks joining us online, I think we sanitized the model so that folks don't know the actual deal. We want to be respectful of the broker, the seller, and so we're not going to specifically mention the deal that we're actually looking at here, but can you give us just some general parameters about the deal?
Absolutely. Yeah, so it's 115 units, kind of garden style, multifamily, right down the line of what we typically look for. It's built in 1975, so kind of a classic vintage for us, located in Burlington, Boone County, Kentucky. So just 30 minutes southwest of Cincinnati, where we actually have a pretty decent presence already, and that kind of caught my eye off the bat.
Yeah, great. And Justin, so for the folks online, in any given fund, we'll get maybe about 650 deals come across our desk. We'll only do this for about 100 deals. So we'll do deep due diligence, deep underwriting on about 100 deals. And we'll only acquire 15 to 20 of them in any particular fund. So I thought that was like kind of interesting, just in terms of, you obviously decided to do the deep due diligence on this one, to do the underwriting model. What was it about this deal that kind of made you want to do the deeper due diligence?
Yeah, really, like I said, it was primarily the location. We really like Cincinnati. We have a decent footprint there. We're bullish on the market. We understand its fundamentals, and we've been wanting to break into Kentucky for a while. So this was kind of just like a clear kind of first deal where it's close to Cincy. It's just 5 miles from the airport, down the street from a hospital, down the street from really solid school district. Mm-hmm. So that was really good to see, as well as just the size. It's 115 units. So that checks our 100+ unit box. It's probably going to land somewhere over $10 million in terms of purchase price. So that checks our $10 million purchase price box. The vintage is also a thing that caught my eye. A lot of other groups like us of our size tend to kind of stray away from this vintage, where we're actually really excited by it because we have a great process where we can go in, do thorough due diligence, capitalize appropriately, and really kind of take lower B, higher C properties in solid B submarkets and make them like fit in really well with the community and provide more quality housing for those tenants.
Yeah, makes sense. You talked about Burlington a little bit. And we're going to jump into the financial model here in just 1 minute, but some things you like about Burlington, some things you don't like. Any additional color commentary you want to provide?
Yeah. Well, so it's in Boone County, and Boone County is actually, according to Niche, the second best county to live in Kentucky. So off the bat, that looks pretty nice. Burlington is a pretty attractive neighborhood within it. Kind of smaller, but it has really solid school districts, low crime, high median area household income of about $100,000. Some more expensive housing in the $300,000 to $400,000 range that makes renting a little bit more attractive for tenants. And stable, steady population, growing a little bit, and pretty diverse employment base that leans a little bit towards industrial, logistics, manufacturing, but given its proximity to Cincy and hospitals and schools, there's a good mix of employment.
Yeah, nice. I like it. So sounds like a good sub-market, good sort of undergirded economic drivers, the kinds of things we like. It's suburban, but not sleepy. It's got some real activity. Anything else just before we jump into the model here?
No, I think that's a good kind of preface to this, and let's hop into the details.
Okay, great. Awesome. So let's jump into the model. This is the model here. Now, this is a beast of a model. This thing takes like 5 minutes anytime I try and open it online. You got tabs and tabs and tabs. So we're going to go through this a little bit. Now, obviously, The way I think of this is this is the process that we would go through before we go to investment committee.
Exactly, yeah.
So like we're going to kind of talk through this almost as if we were getting ready to go to investment committee.
Yeah.
You've done the deep due diligence, but there are some things where we might want to tweak assumptions and continue to think through, hey, do we actually want to do this deal?
Yeah.
So
I would add that typically asset management will take a really deep dive into this once we go to investment committee and think that this is something we actually might want to move forward on.
Yeah, makes sense. So we already talked a little bit about the property. So this is our inputs and assumptions tab. Kind of go through the inputs and the assumptions. Let's just talk about the acquisition assumptions first. What are these? Can you talk a little bit about the stabilized yield on cost and the cap rate? Some of the details you've got here.
Yeah. So asking is 11.25, which is about 98,000 a unit. Mm-hmm. So here I like to show the asking price. And then we have stabilized yield on cost, going in cap rate, and that kind of helps frame what it is we might actually be willing to pay for this property. Mm-hmm. And typically I'll go through the assumptions, the CapEx, what we think we can do, the business plan, and then kind of revert back to what we actually think we can pay for this. Mm-hmm. So maybe just high level we can go through, and then we might revert back to this at the end. So they're asking 11.25, that's 98,000 a unit. Stabilized yield on cost of 7%, which is basically just the NOI in the stabilized year divided by our all-in basis for the deal, which we'll look at when we get to the sources and uses tab. You can see that that's a positive leverage to the interest rate that I'm modeling for our debt, and we can talk about that a little bit more later too. And it's also negative leverage for the going in T12 cap, which is generally expected for this kind of deal. Mm-hmm. But we might not be super comfortable with these numbers. But again, we'll circle back here.
Just for the folks joining online that might not know what that means, what's positive leverage versus negative leverage?
Good point. Positive leverage basically means that our yield, our cap rate is greater than the interest rate, and even more specifically, greater than the loan constant. So that's the actual debt service that's paid divided by the loan amount. This means that we're creating value, basically.
Okay. So the negative leverage piece, is that more common now that interest rates are higher?
For sure, yeah. And specifically when we're looking at floating rate debt, these days we're looking at deals of this kind of profile that typically have anywhere between a 200 to 300 bip spread over SOFR. Mm-hmm. And SOFR right now, as we all know, is unfortunately pretty elevated. But, I think while there's risk there, it also presents a lot of opportunity for groups like us who have done this many times and know what we're doing and are well capitalized to do it.
So I look at these cap rates and yield on cost, and I kind of think to myself, okay, not terrible, not amazing. It's kind of like an okay deal. So What made you want to do the deep due diligence on this?
Yeah, again, I think it has the profile. It has a lot of things we're looking for. I think that purchase price probably is not going to work in the end. But, in terms of specifics here, 583 does not seem like a bad cap rate on T12. It certainly doesn't. When you dive a little bit deeper, when you double click into this stuff, this is more like a 6.75, 7 cap market. So to pay a 583 cap for a 6.75, 7 cap market is a little bit like paying a premium for the in-place cash flows. So we want to make sure that we're able to build that yield on cost to an attractive spread between the going in cap and that stabilized yield on cost. And I'd expect, at least 150 bips, which we're not quite at here. And I'd expect probably to need probably a 750 bip yield on cost, which we're also not quite at here, which means we'll probably have to adjust that cap rate a little bit.
Gotcha.
Or that going in purchase price.
So where do you want to go next? You want to talk about financing? I think like income and rent growth, or maybe a natural area to go next.
I think probably rents. So we could take a look at the rents. Probably scroll down a little bit farther. Second half of this page, right there, the unit mix.
Okay.
So this property, there's 1 and 2 beds. There's 2 sets of 1 bed units. One of them is basically just a little larger than the other. The average in-place rent today is $942, and you can see that over in column F there.
Yeah.
After looking at rent comps, which we'll go look at in a second, and also doing some other analysis, I think we could probably take rents to that market rent column today if we were to take over the property, with, of course, some loss to lease baked in. And you can see, actually, if you scroll over just a little more to that yellow, there are actually units currently achieving those market rates right now, if not more.
In the property.
At the property. And
Gotcha.
One thing you have to make sure of when you're looking at that, though, is you want to make sure that those units that are achieving that rent aren't achieving it because a tenant has been in there for a long time and they've seen lots of rent growth over the years. You want to make sure that they're actually leasing units for this amount, like right
New
now.
leases,
and I did a little bit of that, and there are some units there.
So there's a variance between the rents for exactly comparable units in this particular property.
Yes.
And that gives you some assurance that you can bump the rents to what you have here as the current max.
Exactly. And that's the market rent. So we also have post-reno rents in here, which means we think on top of achieving market for the units today, we could probably put somewhere between 10 and 12 grand a unit into these properties and achieve, call it a $200 premium, which would be hopefully 15% plus return on that cost. We'll talk a little bit more about what that CapEx plan might look like, but I think it might be helpful to jump over to the rent comp tab now and take a look at how we're thinking about market rent, post-reno rents at this property. So these are the one bed units. I think if you scroll down a little bit, we can see some averages, which might make it a little easier, a little to the right. So average would be $1,155 for our comps, and that would be units today. So that tells me that we're under market as it is already.
Yeah.
We might not want to take units all the way up to that average, which I'm not doing in the market rents I just discussed, but we definitely have some room to move. Then if you move over to the right side, keep going right. These are newer, nicer, more renovated comps. So they're not exactly comps. It's really just like a backstop on what we want to stay under in terms of pushing rents.
Gotcha.
And if you see that, look at the averages here, scroll down a little bit to the right. One beds are $1,300. Two beds, if you keep going down, are $1,600, $1,700. So if we're somewhere in that, probably call it $1,050, $1,100 range for one beds and $1,200 range for two beds, $1,250. I think that's a pretty comfortable delta, assuming we do our thorough diligence on all these comps, make sure that the amenity packages line up with what we're doing, and assigning some discounts to all that stuff.
Yeah, that makes sense. Just so that folks joining from online understand this full model, because I keep seeing the rent in green, but then you got the square foot and the rent per square foot in red. So my read on that is that these are larger units in the comps than the subject property. And we also then have rent per square foot that is lower per square foot in the comps than the subject property. Is that right?
That is right. When we look, so it's actually interesting because a lot of these properties are newer, and usually in newer properties, you're going to see smaller units. There's actually some studies that say that more recently, those units are actually, in terms of size, expanding because tenants are demanding more space. Yeah. So it's a little uncommon here, but
is that a post-COVID thing?
It is kind of a post-COVID thing. Yeah. Specifically in New York, where units are typically extremely, extremely small. People are saying, if I'm going to live here, I need some more space.
Yeah. So especially if they're working from home.
Especially if they're working from home. Yeah. So we take all that into account. That's why I think this $500 spread is, I typically look for like more of $200, $250, $300, but I think we need to be at a little bit bigger of a spread given the fact that our units are smaller.
Gotcha.
And tenants don't usually pay attention to rent per square foot, but we certainly do as we're going through all this.
Yeah, that makes sense. And I think it was the same thing over here for the current comps. In addition to the nicer, newer ones, you got this green in the middle with red on both sides, which is just an indication of what we just talked about there.
Exactly.
Okay.
Yeah. Go ahead. Might make sense to jump into the CapEx details.
Yeah, you want to jump into that?
How we're getting those rents.
So CapEx detail?
Yeah. So this is, again, just kind of a placeholder for now. We haven't visited the property. We haven't done a whole lot of due diligence. There's no OM on this property. So we're working with what we got here, which is basically CoStar pictures, Google pictures.
Yeah. And is that pretty common? I know we get a lot of deals off market, so
Yeah.
I'm guessing a lot of times we're seeing stuff without an OM.
A lot of times we are, and it can be a little bit more difficult, but it's also great because we have brokers that know what we're looking for, and they know that they can send us financials, and we can evaluate things pretty quickly and effectively, rather than needing a lot of the details that other groups might need.
Right.
And we have a lot we've done this deal profile a lot, so we have a lot to comp it to as well.
Yeah.
So basically here we're showing this is going to need new cabinets, it's going to need new countertops, LVP or LVT throughout, and new appliances. Not exactly sure the finish level of all these. Like, I don't exactly think we're going to need quartz countertops, but probably a nicer Formica. We're also addressing exterior deferred maintenance stuff. The broker actually told me that he did not identify any deferred maintenance at the property. It's a 70s
Don't
property.
brokers always say that, though?
It is
that
kind
sounds
of
like
common.
something a broker would say. Everything was great.
Everything
no
was great.
deferred maintenance. Looks wonderful.
Yep, but I definitely want to be
No
pretty,
offense to our brokers
Yeah,
who are
he's
watching
great.
online. We love you all. Thank you for sending us deals. So
Yeah, I definitely want to be pretty conservative though when I'm looking at this stuff. So about $1,500 a unit to make sure that we have things satisfied, and then just I can tell that these properties are probably going to need some new roofs, some brick pointing, and some asphalt throughout the life of the hold. So that's about what we're thinking. 1.7 million bucks, pretty typical. It's just over probably 10% of what the purchase price might be. So kind of like a medium-ish value add here.
Yeah, makes sense. And I noticed you have a contingency built in. How do you calculate the 5% or something?
Oh yeah, 5%. It's on the inputs and assumptions tab. Sometimes
Okay.
we'll up that a little bit depending on the age of the property, the diligence process. But I think 5% is appropriate here.
Yeah, makes sense. So, $15K a unit is kind of what you're thinking, and then that gets you those post-reno rents.
Exactly.
That's kind of the story.
Yeah.
And if we didn't do that, and you get the market rents, you can still bump them a little bit. But then doing this CapEx plan lets you bump them even further.
Yeah, I actually think, and we've experienced this at some of our properties, we can actually come in, address deferred maintenance, make the exterior look nicer, do some landscaping, and just like create more of a community vibe and see higher rents just from that. But I think also taking it a step further and doing these unit renovations really is impactful.
Yeah, makes sense. All right, how about we look at expenses? What do expenses look
Sure.
like? Where's the P&L on here?
So we can go to P&L consolidated, or we can go to annual pro forma.
Now, this is existing, or
That's the current T12,
Oh, I see.
and then just breaking down the T12 a little bit into T9, T6, T3, T1.
okay? Now, they sent us these financials?
Exactly. Yes.
So the seller has good financials in this case, because I know sometimes
Yeah.
they were using back of a napkin for their financials for the past couple of years. So you got at least somewhat of a sophisticated seller here, I'm guessing,
Yeah.
if you were able to get this.
Often they could be quite difficult. This one is pretty decent.
Yeah.
I think this seller knows what they're doing. They're actually recouping a decent amount of their utilities, which is pretty kind of uncommon for this profile of deal. So it's nice to see because the income is there. But I think actually there might be some more juice to squeeze on that front too.
Just for the folks online, can you talk about recouping utilities? I know that that's a strategy that we employ that's incredibly effective, like rubs and can you talk about what that is?
So actually in this specific case, I have an open question to the broker regarding who pays what in terms of utilities. But typically if the tenant is not paying certain utilities like gas, electric, water, sewage, that kind of stuff, trash, and the owner we can actually charge back a percentage of those utilities to recoup them because we're paying for them, and often they can be based on how much gas the tenant is using, how much water the tenant is using. So it's a fairly common practice, and we have a really good partner that we use to help us through the RUB system. They evaluate all our deals and let us know what they think is achievable for that specific deal.
Yeah. Awesome. Cool.
So
back to the P&L, some of the expenses are already being recaptured through utility bill backs. Can you just talk a little bit about, what does the P&L look like from an expense standpoint?
Yeah, so if you scroll down a little bit there, here are our expenses. Might actually make more sense to look at these on the annual pro forma tab just because it's a little easier to view. If you zoom in a little bit and scroll down a little bit. Yeah, scroll up a little bit. right there. Yeah. So what you're seeing in column F is actual in-place expenses today on the P&L.
Okay, so just orienting our folks online, 1.3 million of total income is coming in today. And were they doing gross potential rent and then lost to lease, or did you have to back into that?
They were doing that.
They were.
They
Okay.
made it a little easier.
So just for folks online, this is how we like to look at revenue for our property. We like gross potential rent, which is the amount that the property can produce from a potential rent standpoint, and then we break out loss to lease, vacancy loss, bad debt, concessions, as you can see, non-revenue units, down units. Then we get other income. So you got the utility reimbursement here. That's what we were just talking about.
Yep.
So they're actually capturing over 100K of utility reimbursement. That's great. We can talk about what your pro forma is on that. And then other revenue, main drivers are laundry income. I'm guessing other fees is like application fees,
That
stuff
kind
like
of stuff,
that?
yeah.
Okay, so that's the income. Let's get into the expense side of things. This is where we love to dig in. There's always opportunities here. So what do you see on the expense side?
I think this is also a specific part that will definitely evolve over time as we continue to look at this, get questions answered by the brokers, and we get other sets of eyes on here. But as we are right now, column F is in place. Column I is our performing year one. You can see that we're increasing expenses a little bit. Some of that has to do with taxes. We're using the broker's pro forma tax number here. We're going to dig into that a lot more to verify it over time. PM payroll, you can see, is a little bit lower than in place, and I think that this property actually is it's a good property for staffing, and we can look at what we're doing in some of our other properties to get an eye for this. Gotcha. I actually think how they have this staffed is how we would have this staff, which is one full-time property manager and one full-time maintenance tech.
Okay.
And that's what those numbers are representative of there. We just have a slightly lower burden than they do in terms of PM payroll. We added some auto and travel expense here because we are a Pittsburgh company, and I believe that they are located in Cincy, meaning they don't have much of a travel expense. Yep. In terms of cleaning and maintenance contracts, it's a really good place to dig in, and our asset management team will give a lot of insight there. I'm currently just showing keeping their contracts in place, but there will probably be some opportunity to look at some other options there. Mm-hmm. Insurance is another interesting one. They're actually paying about $640 a unit in insurance, which is really high in our portfolio. A lot of people might be surprised by that because they're looking at properties maybe in the Sun Belt that are $1,000 plus. Right. But our average across our portfolio is about $350. Wow. And in Cincy, we're probably in the $400 to $500 range. Mm-hmm. But I'm just keeping their insurance in place for now, and we're going to get quotes, and if we move forward, and we're going to see if we can find some value there too. Gotcha. So there's a lot of room to find value in this stuff, but it's also helpful to look at it relatively conservatively on the front end.
Let's talk about property taxes real quick. Sure. So you've got those going up from 93 to 121. Yeah. You mentioned that you're factoring in a tax reset. So is that expecting there to be a reassessment or just a new?
Yeah. So I need to do more research on how they calculate taxes in Boone County. For now, I'm just going with the broker's number, but I, of course, have some work to do to verify that. And we have a very, very effective in-house counsel that specializes in property taxes. So he's going to be very instrumental in figuring out what this exact number should be. But yes, this is a reset, and I am showing annual increases in this over time.
Is an entity purchase possible here, or do you not know yet?
I don't know yet. That's a question that we have outstanding.
Okay. So folks online, our postures, if we can, we'll acquire the entity to reduce tax reassessment risk. If not, we have in-house counsel to appeal the assessment when and if it does happen. And then you've factored in basically, I would think, kind of worst case scenario here in terms of expecting an increase and actually having a decent increase in taxes. Yeah. So that makes sense. I'm going to keep things moving along. We could obviously spend tons of time on that. Why don't we talk about kind of capital stack and returns? What's the structure, financing, otherwise? Where do I go for that?
Sure. Let's go to inputs and assumptions, and then we'll probably jump to sources and uses. So yeah, this is the spot. So this will obviously be adjusted over time as I start having conversations with debt brokers or lenders. But this is basically how I'm thinking about this this loan for this deal profile, which is value add as opposed to buying a property that's stabilized and going to cash flow day one, where we could probably get a fixed interest rate and probably wouldn't have any interest only period. This is basically showing a $8 million loan amount coming to the door day one, and then if you scroll down, we're showing a little more, a $1.7 million future funding of all of our CapEx dollars.
Okay.
So it's probably going to shake out to about a 65% loan to cost, and those dollars will come as we're doing our CapEx plan, which is probably in the range of 5 to 8 units per month, and until this stabilizes. So I have an interest-only period for 12 months baked in here. We have our origination fee, if you scroll up a little bit. And then I'm sizing this at the moment to 275 bips over SOFR. Okay. We've been able to hit 250 on a couple recent deals that are similar profile to this, so that would be great to hit. But this is where I'm at for now.
What's SOFR right now?
Oh man, SOFR is over 4%.
Okay. So you're looking at 6.75, 7%.
Yeah, that's
all in?
about right. Yeah.
Okay. Just for the folks online might not know what you mean by the spread there and kind of what we're seeing in the market. So that's bringing in new financing. Sometimes we'll try to assume the loan if we can, particularly if it's a good interest rate. Did we look into that for this one?
Outstanding question. We don't know the current loan that's in place, but it's always something to look at if it's more accretive to the deal. We also could potentially do a refi here, which is not modeled, but we typically work with community banks that are really flexible and allow us to get out in year 3 or year 5 or whatever really works best for us.
Yeah, makes sense. So then you got the debt, and that leads to thinking about equity. So
maybe jump to sources and uses. Yeah. So this is really a breakdown of everything that will be spent on this deal. That's purchase price. That's closing adjustments, which is prorated taxes, lawyer fees, title, all that kind of stuff. We have the lender's financing fee, our brokerage fee, CapEx dollars, our working capital reserve, which we like to be kind of very, very conservative in, at least to start. We typically start with like 2% of the purchase price for working capital reserves. We compare that to how many months of debt service that covers. If it's about 6 months of debt service, then that makes us really comfortable. But we always can adjust that to what makes sense for the deal. So that basically, with all this in place, with the loan funding, the CapEx, we need about $4 million in equity here. So well, often we might go to an outside institutional JV group to do a deal with. This kind of check size makes sense for us to do, with our fund fully.
Yeah, that makes sense. So you calculate all the uses of the capital, you figure out the debt, and then you kind of back into the equity based on those.
Pretty much.
How much equity we actually need. That makes sense. And then what kind of returns on that equity would we be expecting?
So if we go to inputs and assumptions, top right a little bit. Yes. So project level returns here at the moment are 11.3% IRR and a 1.64 multiple for a 5-year hold.
So just again for the people online, what that means is $4 million comes in. You're showing $2.5 million profit coming out at the end of the 5 years.
That's right.
And that's where you come up with the 1.6 multiple. And over the 5 years, that equates to an internal rate of return of 11.3%, which means that's the equivalent of getting that every year, although it will likely be heavily backloaded at the exit. Okay.
Yeah, that's right. Actually, typically when we do these types of deals, there's very little cash flow day one, if not zero, year one, and then that kind of builds up over time. This is actually, this deal provides a bit of cash flow in year one, which is not super common, but it is nice to see because it's a little bit more protective. Sometimes we run what we call IRR partitioning, which is seeing basically the present value of how much your return is associated with cash flow versus how much it's associated with selling the property on the back end. Haven't done that here yet, but it's likely something we'll do moving forward if we choose to move forward.
And I see you have some sensitivities over here.
We do.
Can you just talk about these?
Yeah, I think basically these are two sensitivities. We'll likely do more if we move forward, but basically what this is showing is if we achieved a higher rent premium, if we had a lower or higher exit cap, if we changed our purchase price, what that does to the returns. And I think where we're at on the returns right now, 11.3%, looking at these sensitivity tables, we probably need a higher return for this type of deal, quite frankly, given its risk return profile. So we're probably looking at columns T and U there. Probably staying with that 6.75 exit cap, maybe even, pushing that purchase price down a little bit. I would love to be 16-17% gross IRR here.
Gotcha. So this actually tells you where you need to be.
Pretty much,
from a purchase price standpoint based on your target IRR.
Exactly.
And you're saying you want to be in this world?
About that. So that, I think that is like a good way to tie back to that first table that we looked at, where we're looking at the yield on cost, we're looking at the purchase price all the way to the left over there, and thinking, well, maybe if we plug in 10.75 there to start, we should see the same return that we saw over there. But also, that won't have updated yet. But if you go up to scroll to the right a little bit more, right there, you can see that 15.2.
Okay, and
but
then almost 2x.
Almost 2x, yeah.
And that's pretty much what we target, right? Right around a 2x over 5 years.
That's pretty good, yeah. But when you look at, if you go scroll back all the way to the left, the other side, if you now look at the stabilized yield on cost and that going in T12 cap rate, you can see that those have gone up a little bit.
Yep.
So 7.25 is getting closer to where I think we need to be. That spread between 6.11 and 7.24 is getting closer to where we need to be.
Yep.
And also, if you look at our exit cap at 6.75, we want to see that exit cap be greater than the going in cap rate. But we also want to see it lower than the yield on cost, because that will show that we've created value. In a 6.75 market, we've created 7.5% yield on cost.
Yeah, that makes sense. That's really interesting. So in terms of cap rate, just thinking about T12, I know a lot of times we buy assets from folks who just haven't optimized the rent. So the T12 just doesn't look as good. So how much weight do you put on T12 going in cap rate versus our projection? How do you think of that?
It's a great question. Historically, we've seen really high returns actually acquiring properties at like a 3 cap on the T12, because we've been able to take that stabilized yield on cost to 8% plus, and then we see high teens returns. So
and you mean those are deals we've actually done? We've
actually
acquired
done,
them and run them full cycle, and we can actually see that happen.
So while a lot of groups like to focus on very specific metrics, what is your going in cap? What is your stabilized yield on cost? I really like to take a more holistic picture.
Yeah.
It's not just about those two metrics. It's about the spread between the two. It's about the spread between the exit cap. It's about the price per unit. It's about the price per unit on the back end. It's about the sales comps. And it's really about all of the assumptions that go into this business plan in general. Because if the stabilized yield on cost is 9%, that may look great, but the assumptions could be crazy. So to just focus on stabilized yield on cost, to just focus on the T12 cap rate, doesn't really feel like the most effective way to look at this stuff.
Yeah, that makes sense. Just real quick on exit cap rate assumptions. So just thinking about comps, sale comps. We didn't really talk about those, but what do you like to look at in terms of how you're thinking about our going in kind of purchase price as well as our exit?
Yeah, so not a whole lot of similar trades in this market recently, but I was able to find some other similar markets and similar properties to kind of put together a sale comp table, which you're looking at here. And then below that is like what we would see, what we're seeing now trade for like more slightly newer and renovated comps. So on the top table, we want to be ideally below that average of 94, which we are. It doesn't seem like at this purchase price we're really getting for much of a discount. But, that's just one piece of the pie. You can see your range there. There's stuff trading for in the hundreds that's really, really similar. There's stuff trading in the 70s. So I don't think that 93 is super uncomfortable. But we also want to say, well, what are we going to sell this for on the back end? What's the value that we're creating?
Right.
And if we're saying if we're saying we're going to sell it for whatever we're going to sell it for, we want to make sure stuff is trading in that area right now. So we see 142, and back in the inputs and assumptions tab, we could see what we're going out for. But, this is relatively comfortable. So 133.
Yeah. So you look at those sale comps and you say, even today, there's stuff trading at this dollar amount.
Yeah.
Another thing I like to look at and think about is replacement cost. So, one of the reasons we like our market is because we can acquire below replacement cost. I would think that we're going in, even if we bought it for 93K units, still well below replacement cost, and we're still selling below replacement cost. I mean, replacement cost on an asset like this has got to be, what would you say, 150 to 200 at least.
At least. And it's helpful to take that a step further if you go to sources and uses.
Yeah.
Scroll to the right a little bit. So that 115 number there, that's our all-in basis of the property. So we're buying it for 93. We're all in at 115. We're creating value there day one. I'm pretty confident that given that purchase price, I mean, that's a good place to be.
And it feels like a conservative exit assumption at 133, because I know a lot of people, they'll put this together and they'll say, hey, we're going to have 115 per unit into it and we're going to sell it at 200. I see a lot of those in like underwriting and broker stuff. Again, no disrespect to our brokers joining online, but they'll have assumptions that say, oh, you'll be able to sell for 200K unit. It seems like you're just very conservative with how you're thinking of the exit, which I think is really important.
Yeah. I try to be, but it's also competitive to actually acquire these properties.
Yeah.
So we like to leave some room to be able to push a little bit. Like if we offer 10.5, I'd like to underwrite it to a point where we can find some extra value and come up a little bit if we need to, so we can actually win that deal.
I love that. And I think one of the ways I think about that, maybe you think about that too, is and you've done some sensitivity here on the renovation premiums.
Yeah.
Is there room for us to bump rents a little bit more? Because you can see what that does to returns. I mean, it really, the more you can bump those rents, the more it really starts to become pretty big in terms of the potential IRR.
Yeah. And I think the way I naturally underwrite is so that we can push that number higher rather than lower. So I start off pretty conservative, and hopefully we're able to push that 164 to 200 flat, by the end here.
Yeah, I like it. All right, so the $1 million question: does this deal work? What do you think? Are you recommending this going to investment committee?
I'm pretty bullish on it. I think we still have a lot of work to do. I think we have some other eyes that we need to get on here. I think we need to make sure that we're able to be competitive at this lower pricing. But I like it. I'd like to take it a step further. What do you think?
Yeah, I mean, you're the expert from an underwriting perspective. One of the things I've realized over the years is you really have to get into the details of a deal to know if it's a good deal or not. And I haven't spent time with this deal. You have, so I would be inclined to trust your judgment on bringing it to investment committee or not. One of the things I've always thought about is, the devil's in the details. Not saying that other people do this, but I think you can tell a story that's rosier than the reality by just modifying these assumptions. So we would be doing ourselves a disservice if we ever did that.
Yeah.
Because then we're going to buy an asset that's not going to perform.
Exactly.
So I like your conservative approach here. My sense is you're telling a real picture. Based on what you've shared with me, I think running this up investment committee makes sense. Where do you think where do you think this trades at? Where do you think the right purchase price for us is as a buyer?
Yeah, I would probably want to come in a little bit below this 10.75. Yeah. And I try to think about it more in terms of price per unit. And while they're mid to high in askings, 90s, I tend to think that we should come in probably high 80s and see how that's received. And then probably have some wiggle room to low 90s.
Yeah, makes sense. I like that. I mean, I agree with you. I think that makes sense. It gives us some room. You did mention it's pretty competitive right now. So assets like this don't trade that often. And, sometimes folks have to get a little bit aggressive on buying them. And so I wouldn't be surprised if it trades above that. I think we as a buyer would basically say, this is our price. Yeah. This is what we can do.
Yeah. And we'll sharpen our underwriting before that too, and see what additional value we can find, which might make it easier for us to come up a little bit. But we tend to be have a lot of conviction what we bring.
Yeah, awesome. Well, thank you, Justin. Appreciate you
Thank
doing
you.
this. This was really good. I know that this was a lot of your time. Hopefully, folks online, you got some value out of this. Again, this is us underwriting just a real deal that we're actually looking at. Feel free to check us out on LinkedIn, follow us on LinkedIn, YouTube, subscribe. We're on Facebook as well. So we're happy to be a resource for you if you have any questions, but otherwise, this was us looking at a real deal. Like I said, hopefully it added some value to you, and we'll look forward to seeing you all next time.
Thanks, everyone.
Thanks.